Have you heard the story of the individual who's very successful, owns a couple of home properties, receives income from individuals paying him or her rent every month? That does sound like a pretty good and sweet deal, right? But what if you don't own properties and you own shares in a company? Well, what if I told you you can do something similar in the world of the stock market? We won't be owning physical property like a home, but we own equity in different companies which we are invested in. I'll show you more in this, and this is called the covered call. Ladies and gentlemen, welcome to the study. Going to be talking about covered calls, which some of you who follow me already may know I love to use this strategy. I share all my different trades and ideas over at Trade Study Vision, so if you're interested in that, make sure to check it out over at thetradestudy.com. And if you guys really want to help me out, please make sure to like the video. I appreciate every single one of you, and it is an honor to be sharing my knowledge with you. All right, so for us to jump into what is a covered call, we first need to understand options. And I've put together this little guide here to kind of guide you along the way. There is a lot of information here, and I'm compressing it all into a nice short video. If you guys do have any other questions about this topic, you can always reach out to me whenever, okay? So we need to first make sure that we know what an option is. And what an option is, simply, it's a derivative asset tied to the underlying asset. In other words, it's tied to the performance of an individual stock. And for every option, there is an agreement between a buyer and a seller. The buyer purchased the options contract by paying a premium to the seller. So the seller who receives the premium up front in the transaction, he is selling the call. When buying a call option, the buyer has the right to purchase the shares at the agreed price. This is also known as the strike price. And this strike price is at or near expiration when this right kicks in for the call option purchase to go through for the buyer. As for the seller of the call option, this is otherwise known as the writer. The writer has the obligation to give up their shares to the buyer. An option contract usually is around base to 100 shares. So if you are trading 10 options contracts, this sums up to about 1,000 shares in agreement. So another important point about options contracts is they have expirations. Unlike owning stock, the longer the expiration date, the more time premium will be added to the contract. Why is this important to know? Well, if you look at a shorter expiration date on the contract, there's going to be less premium. So that means you're going to get paid less as you're selling the options contract. And knowing the expiration date is crucial to selling covered calls because you may have a day in the market where the stock performs really well to the upside, and let's say you sold some calls before. Well, guess what? That's going against you on that trade, therefore putting you in the red on your covered call position. But if you have extra weeks or months of time on your side, the stock doesn't continue to have this massive move to the upside, then the time premium is going to decay from that contract, therefore putting you back in the green. That's the idea, and that is ultimately the end game goal here with selling covered calls. So ideally, you want to sell covered calls when there is added premium, so you can collect the most money while you can up front. So then you want that option to decay to zero, or maybe you want to make 50% on your money and buy it back to close it out. Again, you're taking advantage of the time premium. And I'm going to keep on repeating that because that's the goal here. We're generating income over time. And doing this consistently can actually help generate a pretty nice stream of extra income. And so you may be asking, well, Dave, how do we get started and how does this all look like? Well, first, before we get started, you will need to own at least 100 shares in stock. And this is your collateral in case the trade goes against you, since the seller is obligated to sell the shares if the market share price is worth more than the strike price. So, for example, I put an example here. You buy the shares at 20, you sell the call at 21, you collected the premium, you're writing it out. Guess what? You reach expiration and the stock is at 24. That is a $3 difference from the strike price that you agreed at 21. So you do times 100, 21, 24, right? That's 2100, 2400, and it's a $300 difference right there. It's going to be coming up as a loss, but you do get to keep the premium that you have up front, so that would go into the calculation as well. So now we're going to jump into Thinkorswim and run through an example kind of highlighting these points. Alright guys, so now we're in the Thinkorswim trading platform, and first thing is first. We need to buy 800 shares of stock, so I have Apple pulled up here. You would just buy, so I'm going to buy 100 at 162 with 51 cents. So it's coming out around about 16,214. That's the bid and the ask. All right, perfect. So I send that order in. Okay, so now I have the 100 shares. And what we're going to do next is go into the trading here, all products, and we're going to look at the options chain. And I'm going to show you something. We're going to look at August. And now that we have our 100 shares, we can now start looking at the call side here, the call options, and look at as we go further out and the prices. The strike price is in the middle here, the expiration date, and then you have the price of the contract here. You'll notice that when we look at the 170, right, it's going for about 93. Now, if we go to August 12th, last week, and the 170 call, that's 1 week less of time, you can see that the price is actually lower to purchase this as a call buyer at 52 cents. So time does make a big difference. How does this look like when we go further out to maybe like December, with 5 months of time, right? Somewhere around that timeline, same strike price, the 170, you get about $8.55. So let's do an example here where I would do a sell. So I would click here. And what we're doing is we are selling, that's defaulted to 10. We got to make sure that we are only doing -1 because we own 100 shares, right? So we are selling, and we are going to collect that premium of $8.35. And the cool part about this is when you confirm and send this, it's going to tell you the breakdown of the trade right here. This is very cool. It has the selling of one Apple, 100 shares, right? This is a contract. December 16, 2022, the strike price is 170. This is a call, and it's telling us that we are going to collect $835 up front. This will be our max profit. The risk here, though, is very important to note. The max loss is infinite. Why is that? Because you need the shares to collateralize the trade. So I think it's coming out as infinite here because it's not registering my 100 shares that I purchased here off the simulation here. So what happens is, going back to that example of, let's say, the $21 and the $24 difference, same idea here, where if let's say the buyer exercises and then says, hey, I want these shares at 21, even though it's trading at 24. And they can do that because they have the right. They are the buyer. That is very important to note and understand that concept, because as a seller, you have to follow through and you have that obligation to fulfill. So, on that note, let's say if the stock goes to 50 and you bought it at 20, and the stock goes to 50 and you sold 25. That was your agreed price, your strike price at $25. And it is a huge gap and a huge significant difference for one contract. That's about $2,500. So if you multiply that by 10, that's where options can get really scary when you are introducing large transactions and large trades. That 2,500 all of a sudden turns into 25,000. And if you don't have the shares to back that up, and this is why it's very important to own the 100 shares, then you are expected to buy those shares first of all. So you better have that capital to buy all those shares and then give them away to the buyer. So again, very important, and why it's a very good idea to make sure you have those shares. And the idea with this strategy is kind of going back to the beginning of the video. You want to build up this equity. You want to build up these shares, and they're kind of going to be like properties at the end of the day. They're going to be homes. You can have a home in Apple. You can have a home in Amazon. You can have a home in Tesla. And guess what? As you get 100 shares each of any of these companies, you can then start selling premium, and you can then collect extra income on top of if the company pays a dividend, which is a share of the company's earnings with the shareholders. Hey, that's a pretty sweet deal right there. So again, remember, let me test you guys right here, right now. So remember, if I am buying a call option, what would that be classified as? The buyer has the right. And the buyer has the right to, let's say, they have a $50 call strike price on that options contract. And the stock is currently trading at $60 instead. That call buyer can say, hey, I have the right to exercise the agreement and own shares at 50 rather than buying the stock at that price of 60, which is then $1,000 of savings by owning the call option. And that is very important to note when you are buying call options and when you are selling call options as well. Those are both sides of the equilibrium that are very important to understand how, at the end of the day, this is trading. And when you are trading these assets, you are trying to, you seek value in it. And that's what you are seeking as a call buyer. You are saying that I can get a discount here where if you can go from 50 to 60, that's significant savings. But as a seller, you may say, I don't think it goes to 60. That's where you come in and you take the options contract, you write it, you sell it to the buyer who thinks it's going to go up there. You keep that income. And guess what? If it doesn't happen, you win at the end of the day. Doesn't that sound very familiar? That's actually how insurance companies work. At the end of the day, your car insurance, all that. Think about it. Put it together. It's pretty incredible, huh? And you're seeing it all play out right here into the stock market, and that is the coolest thing about selling covered calls. You can actually build a pretty nice stream of income from this strategy. So on that note, guys, I want to say thank you for tuning in, and make sure to subscribe here to stay up to date on any new videos, trading. I'm also on Instagram at The Trade Study, where I post some content and fun stuff there too. I want to say thank you again. Sorry it took a little bit extra longer there. If you guys want me to put another video together, let me know, and I will see you in the next one.